Hey everyone, and thanks for jumping back into the cryptoverse. Today we're going to talk about Ethereum. We're going to be looking at the risk levels of Ethereum against Bitcoin. So, we've spoken a lot on the Ethereum USD risk level, and we usually touch on the Ethereum Bitcoin risk level. But in this video, we're only going to focus on the Ethereum Bitcoin risk levels. So if you guys like the content, please go ahead and subscribe to the channel. Make sure you give the video a thumbs up. Also check out the Telegram channel, which you can find a link to in the description below. And also check out the premium list at intothecryptoverse.com. Let's go ahead and dive in. So for those of you who are unfamiliar with the risk metric, it is essentially looking at historical data to identify when it's less risky and more risky to get into the market. This market for this video is the Ethereum Bitcoin ratio. So what does that mean? Well, when the risk is low, close to zero, color-coded by dark blue, it means that it's, historically speaking, a good time to be entering the market. And what does that mean? It means buying Ethereum with your Bitcoin, okay? So a lot of people, we talk about the USD risk levels a lot, but for a lot of people, they don't want to exit crypto, right? They always want that exposure to crypto, and if they're selling one crypto, it's not to USD because they don't want to lose that exposure to the cryptocurrency asset class. It's just going to another cryptocurrency, right? So you still leave yourself room for that potential upside in crypto, but you want to lower your risk systematically while allowing for that higher ROI. So the general idea, right, is buying Ethereum with Bitcoin at certain levels and then selling it back to Bitcoin at other levels. On this chart, we're color coding it from 0 to 1. So if it's red, it means it's historically a good time to sell, and then blue, a good time to buy. Note that this y-axis here, the primary y-axis, is on a logarithmic scale. So each move is 10x. So 10x and then another 10x. Now, we're going to take the color dimension out, and we're just going to plot the risk on the secondary y-axis. So the yellow line is the Ethereum Bitcoin valuation, which corresponds to the primary y-axis, which is the price over here. I know I say a dollar symbol, but that's not what it is. It's just the Ethereum Bitcoin ratio. And then on the secondary y-axis on the right, it corresponds to the risk, which is the red line. Now, the general idea is that you're buying Ethereum with Bitcoin when the risks are low, right? So this is for those people that are, maybe you have a ton of Bitcoin, and then at certain phases of the cycle, you want to accumulate other coins, right? You focus on Bitcoin, but then at some point you wanna increase your potential, your risk-adjusted returns by getting some exposure to, a coin like Ethereum. Therefore, when you're in these risk bands, maybe what you're doing is you're just slowly DCAing into the market. It doesn't mean you're converting all your Bitcoin to Ethereum, of course. It just means you're doing small amounts, right? Because you recognize that the risk level is lower. If it is lower, then you're DCAing in, and if it's higher, then you're DCAing back to Bitcoin. Again, this is for those that are wanting to do crypto to crypto rather than any type of USD or stablecoin transactions. So if you're buying up to 0.6, which is generally what I would do in terms of the Ethereum Bitcoin ratio. Like I personally would not be converting Bitcoin to Ethereum when the risk of Ether Bitcoin is above 0.6. So at that point, I'm converting back the other way. Now, the general idea here, right, is to do it dynamically. But before we get into that, I just want to identify one of the most common questions. We're going to talk about one of the most common questions I get. And it's, why would you ever sell in the 0.6 risk band, right? This is one of those common questions you always get, or I always get. And especially with the idea that, if we're going to go back to, say, 0.9 to 1, why would you ever want to sell over here? Well, the reason is because, first of all, there is no such thing as a sure thing, right? We don't know what's going to happen. We anticipate what might happen based on historical data, but we don't know what's going to happen, and therefore we use that information. The more we know about something, the more we realize we don't know. So since we know that we don't know exactly where it's going to peak, we recognize that, and we just DCA out systematically, right? But we also do it dynamically. And by doing it dynamically, it leaves you, it leaves you room for to realize the highest return at the highest risk level. So one of the things you can note is if you had traded your Ethereum to Bitcoin back over here when it got above 0.6, you can see that it would have been a good thing to do, right? By doing so at that point, you see it go above 0.6, you set that stop loss, it comes back down, then you're just buying again, right? It's a systematic DCA buy. it is not meant to say you sell it here and then the minute it drops a little bit, you buy it all back in. That is not what I use it for, okay? I sell a percentage at this point, and then after that, you're just, if you're DCAing weekly, if it's monthly, whatever, you just systematically do it, right? You don't try to time the market in terms of, every day watching the computer screen trying to figure out if now's a good time to get in. What I do is I DCA the sells, and then if I come back the next week and the risk has dropped down, then I take some of those profits and I just start DCAing back into the market. It's as simple as that. So you can see over here we had something similar happen. So if you were on the premium list, right, which is at intothecryptoverse.com, I put out an alert on the private Telegram channel saying, hey guys, we've hit the 0.6 risk level. This is where I'm setting my stop loss. By the way, it corresponded to around 0.385 or 0.0385. So it did turn out to be a good play, and now we're DCAing back into the market. With those gains that we realized, right? Because the Ethereum Bitcoin ratio drops really quickly. Okay, this is the idea. So you set the stop loss at the risk level or whatever risk level you want. I'll tell you what I'm doing, generally speaking, based on the risk level, and then you wait for it to get hit. If it doesn't get hit, great, right? If it keeps going up monotonically, then you sell that percentage plus whatever percentage you're going to sell at this level at the next risk band, right? If the stop loss gets hit, great, right? Because then it goes down, and then you could start DCing back in, and you basically printed more ether, right? I mean, who doesn't want to print more ether? And this is the nice thing about this is it's very low stress, right? It's more of a I would say it's better to not hope for what happens. Like, don't hope, just react to what happens, right? Just react to whatever's happening in the market. If the risk is low, for me, it means DCA in. If the risk is high, for me, again, it means DCA out. Now, you might say, well, what if we continue going up? What if we go to 0.7 and then 0.8? Well, you just continue selling, right? You don't sell everything. In the same way that you in the same way that you DCA into the market, you can DCA out of the market, which means you don't sell everything at once. A lot of people take that all-in approach, but instead you slowly and systematically make small shifts in your portfolio over time. It's not just like an all-in or all-out thing. Not for me anyways. So in a situation where it would keep going up, right? You set a sell here, it keeps going up, you sell again, and then you sell again, and then you sell again. Same thing later on, right? You sell here, 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 and here. The risk dropped back down to here. Do I buy? No, because the risk is still high. You set the sell, you sell, sell, and sell. And then when it comes back down to these levels, you buy. So if it's in these levels and you're just dealing with the Ethereum Bitcoin ratio and not Ethereum USD, then you would just be buying. And you would be buying systematically. So if you're doing it weekly or monthly, whatever it is, you're just buying. And then when it gets to these levels, you sell. First level, you sell a little bit. Next level, you sell even more. Next level, even more. Next level, even more. It came back down. Then you're using your profits from this point to buy back in. It goes back up. You're using, the amount you were able to DCA back over here. You're selling that up here, okay, to whatever dumb money wants to buy it from you. Comes back down. You start buying again. And the general idea, right, is you're out. Like, at least for me, like you're out. If it makes it to the 0.9 to 1 risk band, I'm out of the market, right? Or I set the stop loss at 0.9, out of the market. I'll see you again when it gets back down to a risk level I'm comfortable buying at again. Okay, so this is the general idea. And this is just one strategy, by the way. This is just showing it up to 0.6. If you wanted, you could just buy it below 0.4, or you could buy it up to 0.8 if you want. Right, I'm just showing you one strategy. So potentially, for those who, I generally find that people that are, really interested in Ethereum are, they do have a higher tolerance for risk, right? Because if you didn't, you'd just be exposed to Bitcoin, or maybe you would just be exposed to stocks. But since you're looking at Ethereum, you recognize the potential for a higher ROI this market cycle. It does improve your risk-adjusted returns when calculating out the Sharpe ratio on the efficient frontier. Therefore, why not take on that extra risk if you're going to take it on? Here it shows you, buying up to a 0.6 risk level and then selling above that level. And you can see here it would have worked out really well because you get in that one sell at least, and then you can continue DCAing with your profits. Again, here, just last week in the private Telegram alerts channel, I said, all right, guys, 0.6, you know what that means? It's time for me at least to set that stop loss, because we know that there's a good chance we go back down, right? We want it to bubble. I mean, who doesn't want to experience a good bubble, right? I mean, we all want it to. But in the meantime, we also recognize that we don't always get what we want. And in fact, it's better to just react based on mathematics and to say, you know what, based on historical prices and historical volatility, it looks like we're getting into one of those risk levels where, it could be time to take some profits, right? And we actually used a pretty similar strategy to DCA out of Link a few weeks ago, which, by the way, went much higher on the risk band. So in terms of this dynamic DCA, if you're new to the channel, the general idea is that you set like various sell levels on the way up. So Y, 2Y, 3Y, and 4Y. So imagine a world where you have, say, 1,000 Ether. If you do have 1,000 Ether, and then let's say you add these levels up, so Y plus 2Y plus 3Y plus 4Y equals the total amount of Ether you have. You solve for Y. Sorry, I overlaid it with this with the Telegram channel, but you solve for Y, so Y equals the total number of Ether divided by 10. If you have 1,000 Ether, it'd be 1,000 divided by 10, or 100. So your Y equals 100. So that means that your DCA cell here is 100 Ether. If it makes it up to the next risk level, it's 200 Ether. If it's up to the next one, it's 300. And then if it's to the next one, it's 400. And this is going back into Bitcoin. Remember, this is I know it says price over here, but it's the Ethereum Bitcoin ratio. So in this world, you sell 100 Ether back to Bitcoin, and then it dropped back down. So we know that the risk reached 0.6. It went slightly over it, and then it pretty quickly corrected back down into the 0.5 to 0.6 risk regime. And then you just continue DCAing back in, right? You just take the profits, and you're getting more Ether. And then if it continues to go back up, you just keep selling, right? So the general idea is you sell more as it continues to go up. Therefore, if you sell 100 Ether now and you see it go up, you're not upset. Then you sell 200. If it keeps going up, then you sell 300. If it keeps going up, then you sell 400. And then by the time it gets to that 0.9 to 1 risk band, you've sold all 1,000 Ether, and you've allowed yourself to sell 40% of it at the highest risk band, while also recognizing the chance that it doesn't make it to that risk band. What if it only makes it to, say, the 0.8 to 0.9 risk band? You don't want to be that one person, that one schmuck waiting for that, certain risk level or certain price point to hit, certain Ethereum Bitcoin ratio, and then it never happens. This is what you don't want to happen, because then you get stuck with holding a bag for a long time that you really don't want to hold, right? Leave the bag holding to the dumb money coming in. If you're the smart money that was getting in early, you want to take advantage of that, right? You don't want to just watch the time come and go, because if you do, then what it means is there's people out there that were the dumb money that came in at, say, like a risk of 0.8 to 0.9. Maybe they put their money in and then went up to this level. Then they sold, they saw a profit, and they're out of the market. What you did was you bought it down here, saw it go up, and then you saw it come straight back down without taking any profits. And I've said this many times. It's really easy for people to just hold crypto. I feel like it's really hard for people to start selling it, because you just always think that you're giving up some theoretical future ROI. I'm just here to say, once you start selling, it actually does become somewhat addicting, because you take the profits. Worst case scenario, right? If you take the profits, worst case scenario is that it keeps going up, right? And then if it keeps going up, it means you would have had a higher ROI had you not sold. But then you have to recognize again that you don't know where the top is. That's the first thing. Like, take a minute, remember, we don't know where the top is, and then go forward with that mentality, right? Go forward with the mentality of, we don't know where the top is, and there's no one out there that can tell you where it is, okay? So then so the worst thing that happens when you sell, the worst thing that could happen is that it keeps going up, and then you just have to overcome the fact that you missed out on a potential higher ROI. Right? This is the worst thing. One of the things that's such a great feeling, which there's a good chance that happens just because of the natural volatility of Ether, is that you take profits. You say set a stop loss at 0.6. If it drops below, you take profits. Yeah, maybe your portfolio goes down in value, but then you've sent it to a safer, like a safe haven of Bitcoin, because we know when the market dumps, if Bitcoin's dumping, Ethereum's likely going to dump harder, right? I mean, I love Ethereum, but this is just what the data says. It dumps harder in the short term, okay? And because of that, it's a great feeling. It's like the silver lining, right? You wake up and the market dumped, I had a stop loss set, because that means that now the Ethereum that I converted to Bitcoin, I could go buy my Ethereum back and instantly have more Ethereum. And if my goal is to see a 5-figure Ethereum in a few years based on lengthening cycle, which is what we talk about on the channel all the time, then that potential Ether could be worth a lot of money. The alternative thing is you just move it to Bitcoin and you just keep it there if you want. But this is the general idea, right? You don't get too upset if it continues to go up, because in that scenario you just sell increasingly more amounts, like you just sell more amounts as it goes up. And if it comes back down, then you just DCA your profits back into it. Okay, so it's just a systematic approach. One of the things with crypto that I think people like to take advantage of is how inefficient it is, right? But we've looked at this before, right? You look at the autocorrelation of Bitcoin, so you compare the price of Bitcoin to a lagging version of itself, the correlation is going down, which means the markets are becoming more efficient. So you either become more efficient too and recognize that people are going to constantly try to front run each new bubble because they're afraid they've seen what's happened so many times in the past, so they try to front run it. Therefore, the bubble pops, sooner than what you might think, because the market's becoming more efficient. The market is not always going to be like the Wild West, right? It's not always going to be like the 1920s, where it's just kind of like the Wild West, and it's kind of like everything goes, and the markets are inefficient. No, I think they will become efficient. I think they are becoming more efficient every single year. It's just a matter of whether you're part of the movement of them becoming more efficient and leveraging that information, right? They're going to become more efficient with or without you, so might as well get on board with the fact that they will become more efficient. So use that information. And use the information that we're going to likely experiencing lengthening cycles and diminishing returns. Use that information to help protect your wealth. Don't look at that information and say, oh, it can't be right, because if that's true, then that means I have to wait this amount of time to see the ROI that I was dreaming of. No, just use it as a tool to recognize when it would be good to potentially take profits. Again, this is not financial advice. This is what I use. Now, in the same way that you DCA your sells, you can DCA your buys, right? So maybe you're doing X, you're buying X here, 2X here, 3X. So that means like if you're converting a certain amount of Bitcoin to Ethereum at this level, if the risk continues to drop, then maybe here you're doing 2X. So then maybe here you're doing 3X, and then 4X, and then 5X, and 6X, so on and so forth. So if the risk keeps dropping, you keep converting it out. On the other hand, if it doesn't, then you start converting less and less because the risk level's rising. So you want to be doing the least amount, right? In my opinion, at the higher risk level, and doing more as far down as it goes. So this last chart just shows the Ethereum Bitcoin valuation against the risk, color coded by time. So you just kind of get a feel for the move up the risk band, back down the risk band, through time, up the risk band, back down. Back up, back down, back up. So every single time we go back up, at some point we kind of hit that peak, and then we come back down. So you can see back in 2019, or sorry, this was not 2019. This was earlier. This was a different time than that. If you go back over here, you can see we had several different peaks. But you can see several different times where it didn't go up as high as maybe one would have expected, right? And there's plenty of situations where this occurred. So just you have to consider the fact that it doesn't always go up as high as one might expect. This is actually, you can see just by the color of it that it occurred back in much longer ago, I should say, much longer ago. So I'm also looking at this. I think the dates on this actually are slightly messed up. Maybe what it's doing, I think what it's doing actually is it's showing maybe the day and the month, or sorry, the month and the day, rather than the year. So don't worry about what this axis shows, the actual numbers. Just recognize that as it's coming through here, as it's going from blue to red, we're basically going from 2015 all the way out to present day, which is right here. So we're going back up it. So we're moving back up this valuation curve. If we continue to move up, we did retrace a little bit, right? You can see we got to that 0.6 risk level, a single day at that point, and then back down. This is why we take profits here, DCA back in when it comes back down, and then if it continues going back up, you just continue taking profits. So if you guys like the content and you think this type of metric would be useful for you, I'll just remind you that you can check out my website at intothecryptoverse.com. You get access to a whole lot of stuff, way more than just the risk levels, but you get access to the risk levels of Bitcoin, Ethereum, Cardano, Chainlink, Litecoin, XRP, and Monero. We're probably going to be adding more. So you get access to all of them, and you get access not only to the risk levels with respect to USD, but also with respect to Bitcoin and Ethereum. So the nice thing about it, right, is if you're just trading with it with respect to, say, a certain coin, you might say, okay, I want to go buy this coin. I want to go buy such and such coin. You look at the risk levels and you say, okay, the risk level against this coin is rather low, so I'm going to convert this coin into this coin, or I'm going to buy it with fiat, right? Or let's say the risk levels have gone up for one coin. A great example of this a few weeks ago was the risk level of Chainlink just went through the roof against Bitcoin. So when I took the profits from out of Link, instead of taking those profits to Ethereum, I took them to Bitcoin because the Link Bitcoin risk was a lot higher than the Link Ethereum risk. And it's just a complicated way of how they're all correlated to each other that you can't really just know just by randomly thinking about it, because it takes into account a lot of different information. So I just have these live risk levels on a dashboard that you can use, and then I'll put on very frequent alerts on the private Telegram alerts channel. You also get access to the private chat room, so you can talk with many of your cryptocurrency closest friends. You get access to a weekly premium video, a weekly premium report. You also get access to all the old premium videos and premium reports. And then you get access to the risk dashboard, and then there's also a dynamic DCA selling strategy dashboard. So maybe you're not sold on some of these strategies, and you want to figure out which one's best for you, right? Whether you want to do like moderate risk tolerance, high risk tolerance, low risk tolerance. You go to this dashboard, you put in how much Ether you own or how much Bitcoin. It's all anonymous, and if you don't believe me, you just make up how much you have, and then it'll show you, based on what you think the projected peak will be and some somewhat dubious extrapolations, what each risk level, like selling dynamically at each risk level, would yield you throughout the market cycle. And it also shows you that if it only makes it up to a certain risk level and not that highest one, kind of what you're leaving on the table with each different strategy. So if you guys like that idea, check it out. The prices are going to be going up soon. The prices will be they'll be going up on September 28th. So if you want to get grandfathered in at the lower price and just write out this information from a more data science perspective rather than more traditional technical analysis, make sure you sign up before September 28th, because once the prices go up, like you're going to have to pay the higher price. So if you think you might be interested in it, you can always pay for it for a month. If it's not your thing, just exit out, cancel your membership at any time. But if it is your thing, right, then at least you got in at the lower price. So prices are going up September 28th, and they're going to be going up fairly significantly again. So make sure you check it out. If you want to pay with crypto, you can pay for 6 or 12 months. And if you pay with, say, 12 months, you can actually get like a 15% discount. So check it out. If that's not your thing, that's fine. Please subscribe to the channel. Check out the Telegram channel. We're almost at 6,000 members. So if you're looking for a community that is moderated by me and a lot of other really good people, please check out the Telegram community, which you can find a link to in the description below. Make sure you subscribe. Please give the video a thumbs up, and I will see you guys next time. Bye.